Hello, ladies and gentlemen. This is Thomas Fross with Fross and Fross Wealth Management, where we attempt to be the voice of reason in a world full of the pundits of pessimism and the wall of worry. As always, please make sure you read the disclosures that were attached to this video, or if you happen to be watching on social media, you can simply go to www.frossandfross.com and read any of the disclosures that you might find therein. So if you were watching the financial news yesterday, then you no doubt saw that the Federal Reserve had their annual symposium out here in the lovely Jackson Hole. Chairman Powell, he concluded his speech after that meeting with a whimsical yet pretty fitting illustration. He said that the Fed is navigating by the stars under cloudy skies, which is exactly what they're doing, right? I mean, they're trying to, how do you slow down the economy without stopping the economy? Which is essentially what they're trying to do, and there's no crystal ball. And so I think the market, if you're watching the markets this week, I think the markets are getting more comfortable with the idea that the Fed is fully aware that their toolbox has limitations. You see, monetary policy is often considered a pretty blunt tool because the Fed funds target rate is one rate for 50 different states, thousands of industries, and people of all ages. Therefore, the policy that gets set must not be entered into lightly. And I think the fact that the Fed is thinking about, or at least talking about, risk management provides a little bit of, I think, comfort for investors who are increasingly confident that the Fed is, that they hopefully will not break something in their efforts to slow down inflation. When it comes to hiking the Fed funds rate, the Fed is, we feel, currently very close to a place where the risk of doing too much is roughly in line with the risk of doing too little, which is maybe a good spot to be. One main reason for risk management is that there's a lagging effect of monetary policy. Tightening credit conditions takes time to filter through the economy, so policymakers are concerned about maybe the unknown effects yet to emerge on the economy from what they've already done. The Fed is focused on risk management now and carefully dissecting the data for any emerging economic cracks. One risk is the rising debt burden amongst consumers who hold balances on their credit cards or maybe adjustable rate mortgages. Our view is that the Fed is becoming even more data dependent. So this week of economic data will probably be especially important to asset allocators. As inflation pressures ease and the job market cools, investors very well could see more improvement in equities as markets look to 2024. We are leaving Jackson Hole, headed back to Florida, because we're going to be there for the golf outing that we're having for hospice on September the 11th at Golden Ocala. If you've not signed up for it, there may be 1 or 2 spots left, so give our office a call. We look forward to seeing all of you in person when we return, and please be safe. I know the hurricane is headed towards you, so please be safe and be prepared. Look forward to seeing all of you in person soon. Have a good day.